Branches of accounting. 1. Financial accounting. The object of financial accounting is to ascertain the results, profit or loss, of business operations during the particular period and to state the financial position, balance sheet, as on a date at the end of the period. 2. Cost accounting. The object of cost accounting is to find out the cost of goods produced or services rendered by a business. It also helps the business in controlling the costs by indicating avoidable losses and wastes. 3. Management accounting. The object of management accounting is to supply relevant information at appropriate time to the management to enable it to take decisions and effect control. Systems of accounting. The following are the main systems of recording business transactions cash system. Under this system, actual cash receipts and actual cash payments are recorded. Credit transactions are not recorded at all until the cash is actually received or paid. The receipts and payments account prepared in case of non-trading concerns such as a charitable institution, a club, a school, a college, etc., and professional men like a lawyer, a doctor, a chartered accountant, etc. B. Mercantile accrual system can be cited as the best example of cash system. Under this system, all transactions relating to a period are recorded in the books of account, that is, in addition to actual receipts and payments of cash income receivable and expenses payable are also recorded. This system gives a complete picture of the financial transactions of the business as it makes a record of all transactions relating to a period. Keywords. Bookkeeping. It is the art of recording in the books of accounts the monetary aspect of commercial or financial transactions. Accounting. It is the means of collecting, summarizing, and reporting in monetary terms information about the business. Financial accounting. Financial accounting deals with the maintenance of books of accounts with a view to ascertain the profitability and the financial status of the business. Transaction. A transaction is a stimulus from one person and a related response from the another. Accounting concepts. The more important accounting concepts are briefly described as follows. 1. Separate business entity concept. In accounting, we make a distinction between business and the owner. All the books of accounts records day-to-day financial transactions from the viewpoint of the business rather than from that of the owner. The proprietor is considered as a creditor to the extent of the capital brought in business by him. For instance, when a person invests Rs 10 lakh into a business, it will be treated that the business has borrowed that much money from the owner and it will be shown as a liability in the books of accounts of business. Thus, in recording a transaction, the important question is how does it affect the business? For example, if the owner puts cash into the business, he has a claim against the business for capital brought in. 2. Money measurement concept. In accounting, only those business transactions are recorded which can be expressed in terms of money. In other words, a fact or transaction or happening which cannot be expressed in terms of money is not recorded in the accounting books. 3. Dual aspect concept. Financial accounting records all the transactions and events involving financial element. Each of such transactions requires two aspects to be recorded. The recognition of these two aspects of every transaction is known as a dual aspect analysis. According to this concept, every business transactions has dual effect. For example, if a firm sells goods of Rs 10,000, this transaction involves two aspects. One aspect is the delivery of goods, and the other aspect is immediate receipt of cash, in the case of cash sales. In fact, the term double entry bookkeeping has come into vogue because for every transaction, two entries are made. According to this system, the total amount debited always equals the total amount credited. It follows from dual aspect concept that at any point in time, owner's equity and liabilities for any accounting entity will be equal to assets owned by that entity. This idea is fundamental to accounting and could be expressed as the following equalities. Assets, equal sign. Liabilities, plus owner's equity, 1. Owners. Equity =, assets. Liabilities, 2. 4. Going concern concept. Accounting assumes that the business entity will continue to operate for a long time in the future unless there is good evidence to the contrary. The enterprise is viewed as a going concern, that is, as continuing in operations, at least in the foreseeable future. 5. Accounting period concept. This concept requires that the life of the business should be divided into appropriate segments for studying the financial results shown by the enterprise after each segment. A year is the most common interval on account of prevailing practice, tradition, and government requirements. Some firms adopt financial year of the government, some other calendar year. Although a 12-month period is adopted for external reporting, a shorter span of interval, say 1 month or 3 month, is applied for internal reporting purposes. 6. Cost concept. The term assets denotes the resources land building, machinery, etc., owned by a business. The money values that are assigned to assets are derived from the cost concept. According to this concept, an asset is ordinarily entered on the accounting records at the price paid to acquire it. For example, if a business buys a plant for Rs. 5 lakh, the asset would be recorded in the books at Rs. 5 lakh, even if its market value at that time happens to be Rs. 6 lakh. Thus, assets are recorded at their original purchase price, and this cost is the basis for all subsequent accounting for the business. The assets shown in the financial statements do not necessarily indicate their present market values. The term book value is used for amount shown in the accounting records. The asset may systematically be reduced in its value by charging depreciation, which will be discussed in detail in a subsequent lesson. Depreciation have the effect of reducing profit of each period. However, a balance sheet based on this concept can be very misleading, as it shows assets at cost even when there are wide difference between their costs and market values. Despite this limitation, you will find that the cost concept meets all the 3 basic norms of relevance, objectivity, and feasibility. 7. The matching concept. This concept is based on the accounting period concept. In reality, we match revenues and expenses during the accounting periods. Matching is the entire process of periodic earnings measurement, often described as a process of matching expenses with revenues. 8. Accrual concept. It is generally accepted in accounting that the basis of reporting income is accrual. Accrual concept makes a distinction between the receipt of cash and the right to receive it, and the payment of cash and the legal obligation to pay it. It helps in proper measurement of income. 9. Realization concept. Realization is technically understood as the process of converting non-cash resources and rights into money. According to realization, concept revenue is recognized when sale is made. Sale is considered to be made at the point when the property and goods passes to the buyer and he becomes legally liable to pay. This implies that revenue is generally realized when goods are delivered or services are rendered. However, in case of long-run construction contracts, revenue is often recognized on the basis of a proportionate or partial completion method. Similarly, in case of long-run installment sales contracts, revenue is regarded as realized.
Friends, if you like the video, please subscribe to my channel and don't forget to press the bell icon. Thank you. Bye-bye.